The IMF and World Bank are meeting in Morocco as they debate the global financial reforms, including two key economic reports that just have been released. Uche Okoronko has more from Marrakesh.
The sprint back to pre-pandemic growth levels still remains elusive as the global economy continues to limp along. That was a grim message from the IMF as it released its World Economic Outlook report at its annual meetings in Marrakesh. Its forecast for global growth remains well below the historical average of 3.8%, slowing to 3% this year from 3.5% in 2022, and falling even further to 2.9% in 2024.
Important divergences are appearing. The slowdown is more pronounced in advanced economies than in emerging markets and developing economies. Among advanced economies, the US has been revised up with resilient consumption and investment, while the euro area has been revised down as tighter monetary policy and the energy crisis took a toll. There is divergence also among emerging markets and developing economies, with China facing growing headwinds, while Brazil, India, and Russia are revised up.
Throwing even more uncertainty into the mix is the escalation of violence in the Israeli-Palestinian conflict. Already, the Russia-Ukraine conflict caused major commodity markets to fragment. Even more geopolitical tensions could make matters worse. And yet another risk could see developing nations hit even harder, causing inflation to rise and triggering knock-on effects to monetary policy.
I think we have to be cautious. I think it's too early to really assess what the impact might be. And as you pointed out, of course, this happened after our round of current projections was closed. But we would have to wait a little bit before seeing what the impact might be. Of course, we all hope for a rapid de-escalation of the conflict and an end to the violence.
Inflation still remains the itch that no one will be able to scratch, at least not in the medium term. While headline inflation has come down from multi-decade highs in 2022, the fund says measures to stem its rise are proving sticky.
All in all, most countries are not expected to return to inflation target until 2025. Taken together, our projections are increasingly consistent with a soft landing scenario, bringing inflation down without a major downturn in activity.
Well, all eyes now turn to monetary policy. The recent move by central banks to tighten rates in an effort to reduce inflation is expected to cool economic activity going forward. But the IMF says, with risks to the outlook tilted to the downside, there's little margin for policy error.
Central banks have more work to do to bring inflation back to target for a sustained period. They must avoid a premature easing.
While the IMF does say that risks to the outlook are more balanced than earlier this year, fiscal consolidation will be key in tackling soaring debt, while structural reforms will be crucial to reviving medium-term growth prospects.
Fiscal buffers have eroded in many countries, with elevated debt levels, rising funding costs, slowing growth, and an increasing mismatch between the growing demands on the state and available fiscal resources.
Also, a stronger focus on accelerating the green transition, increasing resilience to climate shocks, and improving food security will be key. Uche Okoronko, CGTN, Marrakesh, Morocco.
Africa in focus at this year's IMF World Bank annual meetings. The IMF Managing Director, Kristalina, conveyed her gratitude to the host country, Morocco, saying that Africa is inseparable from a prosperous world economy in the 21st century.
A prosperous 21st century is only possible with prosperous Africa. Here are the young people in the north. In the north is the capital, with aging populations. If we built a bridge for capital to travel where it would make a difference, Africa would do well, the world would do well.
Joining us to discuss these meetings in Morocco and everything else that's happening in the world, Anthony Chan, former chief economist, JP Morgan Chase. Good to see you, Anthony.
Good to see you.
The headlines from the IMF World Bank was that they expected inflation to remain an issue next year and possibly, I guess, deflating the year after in 2025. And I'm wondering, does that match or meet what your expectations might be for the world economy?
I think so. I see the inflation situation being a sticky one, but even the inflation forecast that the IMF has is still much lower than it was last year at 6.9% headline. That number is below the 8.7% we had in the prior year. So we are making progress, but that last mile is always a challenge.
If the world and major economies are raising rates, the purpose of raising rates is to slow down the economy. Vice versa, the cutting of rates typically accelerates economies. But let's just take the first part. Where is the risk of the economies perhaps raising by too much, where you stifle growth or suffocate growth for years to come? I mean, that's what some of the bears would say. Are they right?
Well, I think that if you raise rates too much, of course that is a risk, but remember that they still have to deal with inflation. So that's that dance that they have to actually undertake to make sure they do the right thing. What I see as a possible solution is not so much to raise rates aggressively from here. I don't think that's necessary, but rather to keep rates at these high levels for an extended period of time. We've already begun to see in some central banks like the Federal Reserve, some officials giving some hints that they may be already close to the peak without indicating in any way that they're ready to lower interest rates. So keeping rates higher for an extended period might do the trick, and at the same time preserve the current expansion from turning into something worse like a recession.
Some would say that rates are already too high as it is. If you look at what the 10-year bond has done, industries, the utilities, the oil and gas industry, there's so many industries that rely on this long-term financing. And when those bonds come due, they're going to have to refinance it at significantly higher rates than what they had just 12 to 24 months ago.
Well, Phil, when you say high, if you look at the last 70 years, the average interest rate on the 10-year bond is about 5%. So relative to history, the last 70 years, you're a young man, so you probably don't remember interest rates 70 years ago, but I do because I'm much older. So yes, they are high, but I think the thing that bothers me, Phil, is that they went up so quickly, but they went up so quickly because inflation went up so quickly. So central banks almost had no choice but to raise rates aggressively. But now that they've accomplished a good part of their inflation journey of bringing it down, I think that they could probably step back and just allow inflation to come down without raising rates aggressively to the upside.
Anthony, I want to ask
about lowering them.
I want to ask you about two major events this week that are happening. One being Israel. Two is the CPI number that's coming out on Thursday. Let's start with the CPI number. What do you expect out of it? And is it going to show that the Fed is going in the right direction and we don't need to worry about any more rate hikes?
Oh, absolutely. I think this inflation report is going to show specifically the headline number that the Fed is making progress. Energy prices, of course, have been a little bit of a problem, but I think it will show that there is progress. As for the unrest or the conflict between Israel and the Palestinians out there, we know that historically, and I'm working on some research right now, that whenever you have these kinds of conflicts, it raises the potential for higher inflation, and then, by the way, even for potentially slower economic growth.
Anthony, why is that? Why would we get higher inflation if the conflict were to escalate further?
Well, Phil, because all of a sudden, if the Middle East becomes a hotbed for conflict, you can see some disruption of oil activity. You already saw in the beginning, right after the activity, oil prices picking up. They are lower now than they were on September 27, but the initial trigger was to push them higher on the fear that somehow this can cause a disruption of oil supplies. And we know, even the IMF talked about it today, that if oil prices rise, they have the potential to reduce the economic growth numbers that they put out. The only issue is that when the IMF made this forecast, It was, in fact, completed on September 26th before this conflict, but they've already warned you that if this conflict really extends itself, that it has the potential to slow down economic growth, global economic growth, and of course, boost inflation.
Right. I mean, I would expect the IMF and World Bank, given the seriousness of what's happening geopolitically, that will be addressed at some point in the discussion. What do you expect them to say the long-term impact from this conflict is going to be?
I think they will be very candid and say that if it's a short-term situation that is contained and resolved quickly, when I say quickly, I mean within the next 30 to 60 days, which at this point looks a bit unlikely. But if it does, it will have very little impact on the global economy. But if it's something that lasts as long as the Russian and Ukraine conflict, then it could be problematic for the economy, as we saw with the Russian and Ukraine conflict.
Yep, we have two hot spots that are happening right now geopolitically. Anthony Chan, good to see you. Thank you.
Thank you.